Dividend Growth Investors, bonjour. My name is Mike Héroux, and I am the founder of Dividend Stocks Rocks. I'm also a passionate investor. Welcome to this short series to start the year for retirees only, or if you're about to retire, obviously. Today, we're going to talk about 5 ways to generate income from your portfolio. You know, for a very long time, we used the acronym TINA for there is no alternative. Even when I was a financial planner for several years, I was meeting with my clients and I was telling them, well, it would be amazing if you can put all your money into bonds and generate like 5% and then you can retire on that and it's safe, predictable income, you don't have to worry about anything. But unfortunately, interest rates are super low and you are not going to get that if you do a bond ladder or a GIC ladder. You're going to likely generate like 2 to 3%, which is definitely not enough to retire unless you have a huge sum amount invested. So today we're going to look at other possible ways, but actually maybe that TINA is finally dead. Maybe it's the time to look at bonds and GIC. It's been so many years that interest rates have been low that we have completely forgot about bonds. Today, at the beginning of 23, it is probably the time if you want to build a bond ladder or a GIC ladder, which is having maturity from like 1, 2, 3, 4, and 5 years. And then once the first one expire, you just renew that capital into another 5 years. And eventually you get first diversification in maturity date. So you have liquidity all the time, every single year for your retirement. And second, you make sure that you always get the best rate in town every single year once you have put the bond ladder or the GIC ladder in place. Some investors will tell me, but Mike, how about I do like 5 or just 10 years and then get a better yield? Yes, it's true. You're going to get that, but you will lack of liquidity. And the other thing that will lack as well is the fact that you will not be getting better rates if interest rates continue to increase. So you are going all in for today's yield, which is definitely not a bad thing because you know what? It is very possible that the yield goes back down in 2 years from now, depending on what's happening in the economy. We know yield are going up and goes down, so it's important to follow the economy. The second way that is also often forgotten is to look at annuities. So an annuity is sold by an insurance company where you write down a nice check and they give you a promise to pay you a fixed amount every month for X amount of years or until you pass away. So it's pretty much like building your own pension plan. It has been forgotten for many because yields were very low, and when interest rates are low, it's very hard to have generous annuities. At this point, it could be interesting. I would suggest you that you meet with a financial advisor that can sell you annuities, discuss the different types of annuities, because some of them can be adjusted to inflation, which could be a very smart idea right now. Some of them will be good for a fixed amount of years. Some others that can be passed to your spouse or your estate. So you have to make sure that you understand all the little clauses in that contracts before you sign off. But having a part of your portfolio into safe bonds or an annuity will bring you some peace of mind. It will help you to sleep well at night while it generates a yield that is high enough so you can actually enjoy your retirement. For the past 10 years, it was not only the fact that stocks were doing a lot better, but the other part was you're not getting enough income from fixed income and bonds and yields. A third alternative, if you're an income-seeking investor in 23, is to go after covered call ETF. I've actually done some videos on covered call ETF. I suggest you that you click on the link description below to watch the entire video. I'm not going to repeat myself. Long story short, covered call ETF they do what they should be doing, meaning that they pay you a higher yield than investing in stocks. However, you leave a lot of money on the table. The best example that I have is one ETF that is covering the Canadian banks in Canada. So we have the difference between the covered call ETF from BMO and the equal weight ETF for the same banks. As you can see, at every single time since the creation, you always leave money on the table if you choose the yield. So yes, you're going to get a higher yield, but there is a price to pay, and you don't necessarily feel it because covered call ETF aren't exactly a bad product. They're not just optimal for you. So instead of going there, I would definitely consider building an equity portfolio, even though it means you're going to have a lower yield. Overall, the total return will pay back you handsomely. Another solution that a lot of investors go for are split corp. And split corp may sound incredibly great because first, they're complex, so a lot of people don't understand how they work. And there are like great videos on YouTube, so I'm not going to explain the overall thing. But what is really important to understand is most of them, they promise you a very high yield, which they tend to pay for a very long time. But most of them also means that they will not increase their distribution. So over time, inflation is eating out your income, and several of them will show a declining value. In other words, in 10 years from now, you're going to get the same distribution as you are right now. That's pretty much the best case scenario. Chances are some of them will cut their dividend when their distribution when something wrong happens, such as like a market crash, which never happens, right? And unfortunately, you're going to lose some income, some capital from the unit value. You can see on this graph that this is what is the representation of some popular Canadian split corp. Not all split corp are the same. Some of them are working, but I just want to put a big warning here. Just be careful. You may end up not getting that much return and not much income out of this type of product. The fifth way to generate income from your portfolio, after we have looked at bonds, annuities, covered call ETF, and special products such as split corp, is to just focus on plain and simple high yield. Today, I must admit, it's a lot easier right now because the market has been down in 22, opening the doors to some great dividend growers to now pay 4, 5, sometimes even 6% in dividend, which is definitely what you should be looking at. However, again, I have to warn you, you have to be very careful with those. Many of high yielders, first, they do not increase their dividend, and a lot of them will cut down their dividend payment. And when this happens, you lose capital and you lose income. So a lot of investors are telling me, yeah, but I count on the yield and it's all good. I don't care if the value goes down as long as I'm getting paid. Well, here's the thing. You might not get paid. In fall of 22, I did a webinar and I've used that chart, pulling out like the most of the most popular and high yielding stocks in Canada. And as you can see, most of them since 2018 over the past 5 years have not generating anything. Actually, you've been losing money out of them. Why? Because most of them, here's the second chart, did not increase their dividend. Some of them cut it, and in the end, they were not great companies. Unfortunately, a lot of investors are thinking dividends are safe and dividends are secure, and I just have to pick up, scroll down, use a small stock screener, and just be happy with those yields. I'm going to build an amazing retirement plan based on that 8-9% yield and be happy. It's unfortunately not going to happen whenever there are market events such as a recession, a market crash, a pandemic, a housing bubble market, anything that could go wrong. It will have an impact on those companies. Keep in mind, in finance, there are no free lunch. This means that if there's a high yield, there is also risk attached to it. So what should you know? I've told you already, like bonds and GICs could be a good thing. Covered call ETF, not the best, not optimal, but it's still working. Then you go with split corp, not necessarily a good thing. High yield, not necessarily a good thing. And then annuities could be part of it as well. So now you're at this point where you have a part of your portfolio that could be in a bond ladder and some annuities, but the bulk of your portfolio still remains to be invested, right? And the solution is to focus on dividend growers. This is the part that we're going to attack tomorrow in this series for investing in 23 for retirees. So make sure that you subscribe to the channel to not miss any of those videos. I'm going to have videos every single week. And next week, I will have a complete webinar on how to invest in 23, also for dividend growth investors and also for income seeking investors. So everybody will be covered. All strategies will be covered. We're going to talk about what happened in 22, how to position your portfolio next year. So you don't want to miss this one up. I'm going to share with you a lot of DSR newsletters that I've written over the past few weeks, a lot of like stock lists and stuff. So a bunch of goodies. It's 100% free. You can click on the link description below. So Dividend Stocks Rock /YouTube-webinar. That webinar is 100% free. If you cannot make it for the live session, you will receive a replay link. On top of that, you just have to register. So again, link is right there. dividendstocksrock.com /YouTube-webinar. So all right, guys, we'll see you tomorrow. Until then, don't forget to stay invested.